Good afternoon and welcome to the June 2026 edition of NDSU Extension's Agricultural Market Situation Outlook webinar. My name is Dave Ripplinger. I'm an economic specialist with NDSU Extension and the regular host of the webinar. The webinar is a regular program of NDSU Extension, and we target farmers, ranchers, agribusiness leaders, and others who want to know more about current and expected market conditions and their impact on North Dakota's economy. Today's webinar is being recorded, and we'll double check as I say that. And it is, and will be archived on the NDSU Extension YouTube channel. So you're welcome to check this one out and any previous editions. Today we have a full list of presenters, beginning with Bryon Parman, Frayne Olson, Tim Petry, Ron Haugen, and myself will be giving some remarks.
Before I get started, one thing I want to say is those of you who receive our monthly, we're calling it a research brief, Ag by the Numbers. We're going to a new platform soon. Constant Contact will be distributing that, and it will provide an automatic subscribe link as well as unsubscribe if you wanted to do that. And it's just a much easier way to manage that information, who it's going to, and everything else. So be looking for that here in the future as we start distributing that again and down the road. So it's been a while since I've done a macro update. Mainly because not outside of obviously the conflict in Iran, which has been documented and we've all talked about, not much has gone on that really hasn't been developed from that. So I just want to give an update as we head into this summer on kind of what's been going on. And one of the big things that happened in May, we all knew this was going to happen, that former Federal Reserve Chairman Jerome Powell his term ended in May, and a new Federal Reserve Chair was nominated and confirmed and sworn in. And Kevin Warsh, and he was sworn in on the 22nd of May. And now, a few things you may not be aware of. Each Federal Reserve Chair's term is about 4 years, or is 4 years, and it can be renewed, and there really aren't term limits on Federal Reserve Chair. Like Alan Greenspan served for, well over a decade. So these can be renewed by whoever happens to be the president at that period of time. The other thing to know about this new Federal Reserve Chairman is that he actually served on the Board of Governors from 2006 until his resignation, March of 2011. So he was on the Board of Governors during the financial crisis, 2008, 2009, when Janet Yellen was the Federal Reserve Chair. And one of the questions I get, and Frayne's gotten before, and others, is really how much power does the Federal Reserve Chair have? Because on the board, there's actually 12 members. And while so there is a check on sort of how much control the Federal Reserve Chair has, because his vote, or her vote, if it happens to be a woman as the chair, is still only 1/12 of the votes. There's 12 voting members, and so the Fed Chair's vote still only counts for 1/12 of all the votes. But they do hold significant power in some other areas. Traditionally, though, the vote has never really went against, not a majority has ever went against the Federal Reserve Chair's directive or the direction that person has wanted to take. So while there have been dissenting votes, as recently as this spring in, for instance, holding interest rates where they are, or the federal funds rate where it is, or the purchases of the Federal Open Markets Committee, there's never been a vote that went against what the Fed Chair wanted to do. And by that, I mean a majority going the other way. Also, the Federal Reserve Chair is the spokesman for the entire group. They're the one who's doing the, updates at the press conferences after the meetings. They're the ones testifying to Congress. So they kind of control a lot of the public narrative, or what gets out of the Federal Reserve, which certainly shapes, kind of what they do. And the other thing is, markets move based on what the Fed Chair says in their post-meeting speeches, or what they say to Congress. So that's a lot of sway there. And then finally, the Fed Chair can kind of choose who's on certain committees. And there are definitely some committees that are more prestigious than others. And it could be, I don't have any examples or anything like that, but it's been said it could be used as like a punishment if you wanted to be on a specific committee and voted against the directive of the Fed chair and you get relegated or kicked off a certain committee is something that, it's been said something like that could happen. I don't know that it has or any history on it, but so there is the Fed chair does have significant sway and influence, but the big guardrail though is again any decision that's made and voted on by the Federal Open Markets Committee, it's still just 1/12 of the vote. So that kind of hopefully answers some of that. Now, on to what's actually going on. This is the BLS annualized monthly inflation rate, headline versus core inflation. So inflation was up pretty significantly in May, up at an annualized rate of 4.2%, which is the highest it's been since 2023. And the chart on the right, so the chart on the left is showing what the inflation rate has been. It's really been headline around 2.5%, never really getting to that 2% mark that the Federal Reserve is targeting, but it had been significantly lower than the peak of almost 9% in 2022. And then here this spring, largely due to, if you look at the chart on the right, energy prices, because energy is included in the inflation rate, has really driven inflation up the last few months. Now, the other inflation metric they use is core inflation, which strips energy and food out of it. And I had to use a different chart for that. And the missing gap there was due to the government shutdown. But core inflation is just below 3%, right around 2.9%. So between those two charts, it's really showing how much energy is driving that inflation number. And we're all well aware of what's happened with fuel prices at the pump being, very expensive the last couple of months, and that's really what's driven the inflation number. However, core inflation has gone up too, and it's up approaching 3% to 2.9. It had been all the way down to about 2.5, but that trend has kind of reversed. Now, one of the other things that the Fed watches pretty closely is unemployment. And unemployment's really been pretty consistent now for several years. And I've talked about before, if you've ever heard me comment on this, the natural rate of unemployment. We're still, as far everything, when I was going to school and learning about a lot of this stuff, we're still below that natural rate, which is about 4.5% to 5%. And North Dakota has the second lowest unemployment in the country at 2.4. I believe South Dakota had the lowest at 2.2, but we're still just a bit over half of what the unemployment rate is nationally. And even some of the states that traditionally have a bit higher unemployment, theirs is still relatively low, just over 5%. So unemployment really hasn't surged or anything like that in right now. Really, what the big thing that they're looking at is what's going on with inflation. And then as far as markets, and I'm not going to comment too much on equities markets, stock markets, but the S&P has been really gaining, the last few years. Here's the dip right here due to conflict with Iran, but since then it is actually pulled all that back, as well as even exceeded and grown beyond what it was before the conflict with Iran actually took place. So you can see the S&P has been going up. So in terms of like what equities markets are doing and unemployment, not a lot of concern there at all. Things are clipping away pretty good. The big concerning thing being inflation. So the most recent interest rates survey coming out of our 9th Federal Reserve District, which is out of Minneapolis. The most recent survey was Q1 of 2026. That survey concluded in April, and interest rates are about the same as they were for the fourth quarter of 2025, which shouldn't be too surprising. There wasn't a whole lot happening, or not a whole lot happened between then. The Federal Reserve had their December meeting where they lowered the federal funds rate by 25 basis points, but you see that interest rates really didn't change. They stayed, right where they were. I mean, I think some of this is probably just noise, but you could say that really the last 6 to 9 months, interest rates have been holding even for agricultural operating notes, machinery notes, and real estate loans. And then the market expectations for rate changes are actually that if anything, if they are going to move, they're going to increase in the coming months. So the next meeting that the Federal Reserve has is this month, and 98% of the market thinks there's going to be no change. It's currently sitting at 350 to 375 basis point range. 98% think it's going to stay there. July, still the vast majority think there will be no change, with some thinking that there might be an increase of 25 basis points. At the September meeting, the market's expecting a majority no change, but a third thinking that there will be an increase of at least 25 basis points. And then the end of the year, uh, only about a third of the market thinks there will be no change, with the majority of the market, vast majority, thinking that there will be rate increases between now and then. That's a bit interesting because one of the reasons that there was some tension between certain bodies in government in the last Federal Reserve chair was that rates are too high and they need to be brought down to stimulate the economy. And market participants right here are sitting there thinking that, well, this new Federal Reserve chair and the voting body of the Board of Governors, if they're going to make a change at all, it's going to be an increase down the road. And one of the things that we with this Federal Reserve chair is he's kind of on the record during the financial crisis of saying that the Federal Reserve should stay out of markets as much as possible. Maybe his opinion on that has changed some since in the decade and a half since he stepped down from the Board of Governors. I guess that remains to be seen. We'll find out. But that was kind of the position there, that you just kind of the Fed needs to let the markets do what they're going to do and interfere a lot less. Again, we'll see if that's what he chooses to do as he serves out his term. But this is kind of what market participants are expecting: is if anything a rate increase in the next 6 to 9 months, and a lot of that's being driven by what's going on with inflation and the fact that unemployment's fairly stable and the equities markets tend to be doing really well despite some of the ongoing trade disruptions, as well as the conflict with Iran and again trade negotiations that we're going over right now. So I just wanted to give that update, just basically showing what's going on with interest rates right now and what market participants are expecting. With that, I'm going to go ahead and stop sharing. Our next speaker is Dr. Frayne Olson, and I'll go ahead and turn it over to him, and I'll be on at the end if you folks have any questions. Thank you.
Good afternoon, everybody. Frayne Olson. I'm the crop economist, marketing specialist with NDSU Extension. Again, a lot of things to talk about today. Here's my contact information. Again, if you have some questions, please, as David said, put them in the chat or the Q&A function. We'll try and get at them. If there are some things you want to talk about privately, or if there's something that comes up later on, please feel free to reach out and be happy to visit with you. So let's jump in a little bit, kind of an overview where we're going with the discussion today. The June WASDE, which came out earlier this morning. If you look at the numbers specifically, they were basically neutral for corn and soybeans, slightly positive for wheat. And I'll go through some of those in more detail in a little bit. The other thing, obviously, there's a lot of other things happening in the marketplace, not just the WASDE report. The weather conditions have been pretty favorable in general for U.S. corn and soybean development. Crop ratings right now for both corn and soybeans are a little bit behind last year's pace, but still very, very strong. About 2/3 of the corn is in good to excellent condition, and about, let's see, get my numbers right, about the same for soybeans. About 66-67% is graded good to excellent. And I'll show you some maps in just a moment. U.S. winter wheat harvest is just beginning, particularly in the hard red winter wheat areas. About 11% of the crop is currently harvested based off of the USDA crop progress report. Again, primarily starting in Texas and Oklahoma, starting to move into southern parts of Kansas right now for the hard red winter wheat area. There's a little bit of soft red winter wheat harvest going on as well, just kind of dipping in and getting started. From the outside geopolitical standpoint, obviously, the Iranian war is still taking front and center stage. I know there's some reports this morning that President Trump is threatening to have some more aggressive military attacks on Iran beginning either tonight or tomorrow. We'll wait to see what happens to that. Obviously, will have a huge impact on market psychology. The other thing is the shipping delays out of the Strait of Hormuz, again, primarily on the energy complex, but there are some other fertilizer and issues going on. The linkage to what's going on in the war and grain prices directly is really, grain prices is really an indirect impact through the energy markets. I don't have a lot of time to talk about that in specifics, but there is this connection both from the supply-demand standpoint with ethanol in the corn market, but more indirectly through the investment community. When we see the stock markets dropping, when we see energy prices increasing, there's this tendency to move money out of the stock market into commodities. And the commodities include some of the grain complex. And so we do tend to see this connection, this correlation going on between energy prices and grain prices. Most of that, from my assessment, the day-to-day volatility, we say most of that is through these investment community trying to shift money around. The other thing that I'm watching fairly closely, or at least trying to pay attention to, the U.S., Mexico, and Canada are currently in reviewing in the trade negotiations for the USMCA. Now, it's a little bit interesting and to my view, a little strange, is the U.S. is negotiating with Mexico, the U.S. is negotiating with Canada, and Canada is negotiating with Mexico. So even though we're reviewing this USMCA, based on what I can tell, these are going on as bilateral negotiations, not necessarily all three of them sitting down at the same time. Again, it's an ongoing story. We'll have to watch to see what goes on as we move through into the future. So let's dive into the numbers. Really the biggest probably news out of the reports today for both the WASDE, the World Agricultural Supply Demand Estimates, as well as the production numbers or updated production numbers, has to do with winter wheat production, or wheat production in general, but specifically winter wheat. So as usual, the top row on my chart here, or the table, represents the average trade estimate. So these are the numbers that the traders and analysts were expecting to see. We also have what is the highest estimate, the lowest estimate. Highlighted in black towards the bottom would be last month's number. What information do we get out last month? And of course, the red on the very bottom is from this month's report, the information we got out about 2 hours ago. So typically, when we think about market response, market reaction, we compare the blue line on top to the red line on bottom. Mainly, what did we expect to see versus what did we actually get? So when I say it was slightly positive for wheat, if you look at the all wheat production numbers, now this is for production, the market was expecting a drop. They got a little bit larger drop than expected. Most of that, in fact, all of that could be tied back to the hard red winter wheat regions. Now, when I look specifically at some of the major winter wheat producing states, the yield estimate for Colorado will remain the same. For Kansas, dropped about 2 bushels per acre on average across the state, went from 37 down to 35. Montana went from 47 down to 41. Again, that's for winter wheat only. Oklahoma stayed the same at 28. Texas actually went up a little bit from 28 to 30. And then Washington State, which has both hard red winter wheat as well as quite a bit of white wheat, went from 67 to 68. So we're seeing some variability, some shifting going on what the expectations are. When you look at it by class, hard red winter wheat is the one that we were expecting some decreases. The decrease is a little bit larger than the market had first thought, or the analysts had first thought. For soft red winter wheat, about the same, very small change. And then the white wheat, the white winter wheat, actually went up just a little bit. Their expectation was it would be up a little bit, and it was very, very close to what the trade was expecting. So in net, when you look at all bushels of wheat produced, we did see a drop in all wheat production. Looking at old crop ending stocks, so we're going to separate old crop as well as new crop. When we look at old crop, there really wasn't any adjustments other than a small tweak in the corn number. So if you look at last month's number versus this month's number, basically unchanged. The market was expecting a slight increase in ending stocks for old crop. They were expecting a slight decrease in corn and a slight decrease in soybeans. And really the only change that was made was in corn. The reason it was 3 million bushels higher was simply because the estimate for corn imports went up just a little bit. So that was only the small tweaky change that went on for old crop numbers. Looking at the new crop numbers, of course, on the wheat side, we did cut total production. And actually that ended up as a bushel for bushel cut in ending stocks. So there was no adjustment on the consumption side. The production went down because primarily hard red winter wheat. And so our ending stocks are expected to be a little bit lower. The only change in the corn was we saw a little bit higher ending stocks from old crop, which then carried forward into new crop numbers. So the only adjustment really is that 3 million bushels of additional corn imports. Soybeans were unchanged. So when I said it was neutral for corn and soybeans, this is really what I'm referring to. Just a quick update on South America. Again, from the Brazilian production side, the Brazilian corn and soybeans, the soybean number stayed the same. Their harvest is essentially completed. The Brazilian corn number went up just a little bit. The majority of the corn production from a bushel count is actually in the safrinha crop, which is called second crop corn, which harvest is just beginning for the second crop corn. So we're starting to get a little bit early yield reports out of that. So the increase is really, it's not first crop corn, which is done with their harvest, but it's really this larger second crop corn. So it looks like the Brazilian corn crop is up a little bit. On the Argentine side, USDA did increase total bushels, expected total bushel production out for both soybeans and for corn. Now, again, these are not dramatic changes. They're not something that's going to put a shock into the marketplace, but it's just one of those additional pieces of news that, yes, it looks as though competition for corn and bean exports into the global markets are going to be a bit more challenging because the Argentinians have a little bit more bushels to produce or to work with than we first expected. Shifting back to the U.S., let's talk a little bit about weather. I use the drought monitor maps mainly because this is the information that a lot of the market analysts and traders follow and pay attention to. I mean, there is a loose correlation between this drought monitor map and production expectations, but there's a lot of other things that go into it. Obviously, the timing of any kind of rainfall, the heat and humidity can also make a difference. So let's just look at this really quickly. This was updated as of, it was released on Thursday. It was updated as of Tuesday. So what I'm going to show you in just a minute is we're going to trace out any of those areas that were considered D1 or higher. So D0 is that yellow, which just means that the crop is under stress. Okay, the beige color, which is D1, is in moderate drought, is saying, yes, we're starting to see additional yield stress, but also we're starting to see that dry layer in the soil begin to drop and come and go deeper into the soil profile. So anything that's in a D1 or better or larger shows up on this map. So what USDA has done is they've overlaid where do we produce winter wheat compared to the drought monitor map. So the drought monitor map I just showed you, and this one, that red hatched area, is where the drought is D1 or greater. Okay. Now, I wanted to point this out. This is all winter wheat. And obviously, when we look at what's happening in Kansas, that's Kansas, Colorado, Oklahoma, parts of Nebraska, the Panhandle of Texas. That's our hard red winter wheat area. We also have some hard red winter wheat in the southern portion of South Dakota. You know, these regions in here are the ones that we've been hearing a lot about. But I do want to point out, the east central part of Kansas is not in this drought. Let me go back one slide. So this is not considered a drought area in central and eastern Kansas. Now, there isn't as much winter wheat produced in that region. It's primarily corn and soybeans, but there is some, as you can see based on the map. The other area that we saw some reduction in yield estimates from last month to this month is up here in the hard red winter wheat regions of of Montana. And then, of course, we have the white winter wheat region. There's some combination of hard red winter wheat and white wheat produced in the Washington, Idaho, Oregon region up here. So these are the areas that we've been hearing a lot in the news. When we look at what the eastern portion, kind of this Corn Belt area, that's primarily soft red winter wheat. So the soft red winter wheat crop is in better condition. It's not been under the kind of stress that the hard red winter wheat crop is. So we've got to be a little bit careful when you think about winter wheat production and winter wheat crop conditions. Under the USDA reporting system, we're blending both soft red winter wheat and hard red winter wheat. So we got to keep in mind that these different classes are used by different end users. They both play a role. There's some substitution that goes on between wheat classes, but it's relatively minimal. Let's shift now to corn. So this is the same map, but now the dark green is the major corn producing areas, the region we typically call the Corn Belt. And you can see that the Eastern Corn Belt, with the exception of this pocket up here in northeast Illinois, basically up by Chicago, there's some drier conditions starting to show up there, but the majority of the Corn Belt, the traditional Corn Belt, is in very, very good shape. I understand and recognize when we look at southeastern part of South Dakota, when we look at bigger chunks of Nebraska, that those areas are under crop stress, and there's some concern about what the yield and yield potential is. So if we do a percentage, again, USDA does this calculation, approximately 24% of the bushels of corn produced, historical corn production, is under some degree of drought or drought stress right now. Now, again, the corn is relatively small. If we start getting some rain showers, those plants will recover. It's not that we've already dinged it and had a lot of yield loss, but it is something to pay attention to and watch. So in general, crop condition ratings, even though the crop is small, are in pretty good condition right now compared to history and compared to average. Shifting to soybeans, again, just the same map, but we're outlining where the soybean region is. Obviously, the Corn Belt, the Illinois, the Iowa, the Indiana, Ohio regions, as well as South Dakota, Nebraska, are pretty much the same. In the soybean producing regions, we do add this Mississippi Delta region. So if we look at the numbers, about 25% of the soybean production is under some level of drought. So again, in general, we're in good shape, but there are some areas of drought that we have to be watching and be a little bit concerned about. So what's going on in the marketplace? I pulled these charts very quickly from about 12:30, about an hour ago. So the little black box in the bottom here is where futures market prices for December corn, so this would be new crop corn, where were they trading as of about an hour ago? So you can see we've had this pretty large precipitous drop in corn prices. In particular, that's both old crop and new crop, but I'm just focusing on new crop numbers here for just a moment. And I know that's really concerning for a lot of people, and I understand that. What's driving that? Well, again, it's a combination of information about what we expect for yields and yield production on the production side. But then also there's been this shift of money, investment money, out of the grain markets or out of the commodities complex and back into the stock market. So actually today, as of a few minutes ago, crude oil was actually down today, even though there's these discussions about what's going on in Iran, about potential additional military attacks from the U.S. on the Iranian oil infrastructure, Iranian military sites. The oil market isn't responding to it. And as a result now, we're starting to see that money flow that went into commodities now being shifted out of commodities. So the combination of a lot of people selling, as well as the expectation, it looks like we're going to have a pretty good production this year so far, is putting this downward pressure. What I'm telling people is don't get too excited about this. Don't freak out. There's a lot of growing season left. There's a lot of things that can happen. And obviously the world can change very, very quickly, as we've seen in the past. When we look at soybeans, we've seen a reduction in soybean prices. Again, this is November soybeans. This would be the harvest contract month. We've seen some pullback in the soybean prices, not as dramatically, percentage-wise, not as dramatically as what we saw in the corn market. So corn has been hit a little bit harder than beans. And then finally on spring wheat, again, we've seen a pretty healthy retracement in the spring wheat market. There tends to be a little bit more linkage between what's going on in the corn market and the wheat markets. Some of this is harvest pressure. Some of it is from the hard red winter wheat region. Some of it, of course, is also the downward pressure due to this movement of funds or money away from commodities and into back into the future, into the stock market. We're looking at canola. Canola has actually been holding up relatively well. Canola is not as sensitive to these outside investments. Canola typically is not part of that pool of agricultural commodities that are included in these commodity index funds that the financial traders are commonly using. So with that, I will stop. We'll stop sharing here. We'll give Tim Petry a time to be able to go through the cattle information, and I'll be prepared for any kind of questions you might have. Thank you.
Good afternoon, everybody. Tim Petry, Extension Livestock Marketing Specialist, going to hit some of the current events and so on, affecting mainly the cattle market. Just mentioned lambs at the end, but start off, of course, the news right now. The big news last week or so in the cattle has been that New World screwworm finally did get to the U.S. after being in Central America, moving up through Mexico, and did hit us. Just call your attention if you're I'll talk about the market impact in a minute, but if you're interested in following this, although from a market standpoint, probably not real important, is the website is shown above. APHIS has a website that they update every day showing where the New World screwworm is. And so they just pulled this morning. We have 7 cases in the U.S. so far. All but one of them are in Texas and one in New Mexico that was actually in a dog. The rest are in cattle, and then one county had goats in Texas. So it is here. Again, from a marketing standpoint, really should not affect the market other than the border now is going to remain closed indefinitely to feeder cattle coming across. More on that in a minute and show you how many come across and so on a chart. So that would be a positive. The only possible negative factor of this would be the media and the perception of consumers and consumer demand that could affect that. And, I just on a local news channel last night was watching, they show a picture of a steak and then they say, screwworm has hit the cattle industry and this could have an impact on meat and so on. And that is not the case at all. Again, it's a production issue. And so those ranches in Texas that are affected by it affects them a lot because they cannot move cattle to market. They're quarantined and so on, but it does not affect the food supply at all. And the checkoff and the other commodity cattle and beef commodity organizations are trying to get the word out. And so if the big East Coast media would leave us alone, I think we will be okay there, and again should have a limited impact. So, here are the feeder cattle imports from Mexico, and typically the purple line up there is average of 20 to 24. We'd be getting this time of the year around average of 25,000 head of feeder cattle a week in. And this has been going on for many, many, many years. They come across and into the southern feedlots and so on that depend on that supply of feeder cattle. And again, we're very short of feeder cattle. And so, it's when the border does open, and now that's prolonged out indefinitely again. I'll show you the price impact that it might have had last year. Then last year, the light blue line, the border was open from early in February till May 11th or so, and then closed down again when the screwworm moved closer up into Mexico, and so been closed ever since. The red line down there in the bottom, it's been closed all this year and likely to be closed quite quite a long time since we have it here. And even now, Mexico closed the border to cattle coming across from the U.S. because some of their western states do not have screwworm, and they're worried that it might come the other direction. So just kind of an ironic thing there. And again, won't have very much impact on the market because not very many of our cattle go down there anyway. So here then is our prices for 550 to 6-weight steers. And first of all, talking about the impact of the screwworm, there you see in the middle of the chart, that blue line was last year's 550 to 6-weight calf prices throughout the year in 2025. And you see when the border was open, even the market continued to go up seasonally like it usually would. That isn't saying that if the border would have been closed, maybe they would have been a few dollars higher and so on. But when the border eventually opens, if it opens by this fall or whatever, and more on that maybe later at the end of the talk, it's a normal thing that occurred before. And so I think, again, the funds that Frayne talked about and so on overplay the impact that it might have when it does open, because look at last year, didn't have a lot of impact. So now back to the current events and so on and what's happening. Feeder cattle prices are marching along at their continued record high levels. $4.95 last week. That's $100. They were $3.95 last year at this time, so $100, 100-weight higher. So just short supply, strong demand. Again, the three biggest things that affect feeder cattle prices are, first of all, supply, and we know our cow-calf or our calf crop has been down for 7 years now, and likely going to be down again this year. So we do have short supplies of feeder cattle for sure. The other thing that affects the market is fed cattle prices, particularly those distant futures. When these cattle would finish, more on fed cattle in a minute. And then the other thing is corn prices, and Frayne just showed you what's happened to corn prices. All positive for feeder calf prices, or why they're at record high levels. Kind of interesting to me as we go back several weeks, a month and a half ago or whatever, we had all-time highs at that time, over $511. I was hoping that at least one week we would average over $500 on calves, just because I could say, we averaged over 500 and the market bailed me out there. And so that did happen. But again, we're at levels there. I'm going to talk about more my expectation for next fall at the end. But again, last year was just a phenomenal year. Usually in the middle of October 15th is our seasonal lows because of the amount of cattle at least nationwide hitting the market. And last year, every fundamental that could, and we've talked about this before, so I'm not going to expound a lot on that, but those are all listed above. Again, we had strong fed cattle prices, short supply. The Mexican border was closed. We had increased heifer retention because weather was conducive to that. We had an excellent winter wheat crop because it was raining down in Texas, and new feedlot capacity, low corn prices then, like they are now with Corn Belt buyers, and then Canadian buyers with their smaller herd continuing up there in there. So everything that went right could, and so we had seasonally high prices in. So just wait till the end when I talk about possibly some things that could happen. But anyway, we're moving along at record high levels. And again, fed cattle prices affect feeder cattle prices. We already know a short supply, so fed cattle prices. So here's what the fed cattle market is doing. And again, the red line is this year. And we are just 3 weeks off from all-time record highs there, up at 263. Last week averaged 257. Again, $25 higher than they were last year. The cutout value is moving up, and again, Father's Day is approaching, so there's been really, really good demand for beef continuing there. The cutout value has moved up, approaching back up to $400 where it was earlier in the year. And just had news, a weekly export market comes out, and we had the third, last week was the third largest export, in spite of our very high, our high prices here, was the third largest week of the year. of exports. And so all those positive factors, the futures market actually is up $1.50 to or so today on fed cattle. So things moving along there. Looking ahead at those red squares, the futures market is predicting the market to go down like it does seasonally, like it has in the past years. And so I know people get freaked out when the cattle market starts going down, saying, "Is this, some against us or what's going on there?" Because we have a short supply and all that. But it's a normal seasonal thing when beef production increases and so on. And the futures are now saying that we will have very similar prices to last year, which were all-time record high. The fact of the matter is, USDA is predicting the WASDE report that just came out this morning that Frayne talked about. The USDA is predicting $2.50 for an average price for the entire year for this year, and they're actually predicting $2.50 for the fourth quarter, which are higher than the futures. And that could materialize, but again, the futures market is kind of risk off because of the Iranian war and screwworm and all the other kind of factors, and the worry about consumer demand. And high gas prices usually are not good for beef prices, which have not materialized yet, but the longer we go with the war and higher gas prices, so on, that could funnel in. So that's the futures market. But anyway, the futures are under USDA's prediction, but let's just go with what the futures market says as still they are at, like they were last year, record high levels. So going back to what feeder cattle are going to be this fall, our prediction would probably be then for, if corn remains the same, it would be for feeder cattle to be similar there. Then in the WASDE report today, USDA for 2027, that would be these gold futures, which are risk off on the futures too, getting down to 225 or so by a year from now in the fall. USDA is actually their forecast for next year. The average price for the year is $2.54, $4 higher than their forecast for this year. So USDA is still quite optimistic, but again, a lot of things can happen. But this is positive for feeder cattle prices, those distant futures into the fall that are at the similar levels to last year. Go to the heavyweight yearlings, and we have the same story there. We're at record high prices throughout the year. 385 last week in North Dakota compared to about 319, I think it was a year ago, up $66 over last year. Again, all the fundamentals strong there. And go to the fall futures. Again, the fall futures are very similar to last year's. Again, that would go along with the fed cattle that are also at the same level. Actually, the futures market, feeder cattle futures market is very, very strong today, up $5. September futures up there. I just put it in there up at 356, up $5 from yesterday. But again, you saw what's happening to corn, and fed cattle prices are hanging in there strong and so on. So fundamentally, the good news, and even if the market is the same as last year, like fed cattle are, that would still be up at last year's record high levels. Talked a little bit about the futures market that Frayne mentioned and so on. And, the futures market has been extremely volatile, and we've talked about that before. And I just put in, the last few monthly webinars we had where the futures market was at. And, go back to March, we were down there at 335, 340. And then the April future and in April, the September futures were up there at 364, 365. In the last webinar in May, then, there's some announcements then that the administration was going to open up the tariff rate quota to all countries. It didn't materialize and pull through. So then the market came back. And then lately, with the anticipation of screwworm and so on, and the high gas prices and so on, the futures market got very jittery and went down. ironically, the day that we did get screwworm, we went up the limit 10.25 that day when it did come up. So I think, that's, and you see, we were getting way below the cash market. The futures market was getting way below the cash market. That has to be the same by September. And so all of a sudden, when this was kind of, sell the rumor, now buy the fact. And so then we're back up there. So the futures market is jittery. I tell producers, if you want to get ulcers or stay awake at night, watch the futures market. If you want to sleep well, watch the cash market. Because if we go up to that green line, then that's the CME cash settlement price, which is the average price for all 7 to 8.99 weight steers across the country. Would typically, for our 750 weight calves, we would have a positive basis, but up about 800, about a par basis. But yesterday it was 368. We go back to the May webinar, it was 368. We go back to the April webinar, it was 368, and we go back to the March webinar, it was 368. So the cash market has not changed in all of those monthly webinars. It's the same, although there has been a little bit of normal volatility there. It has been the same every webinar, but the future's been all over the board. So again, let's watch the cash market. That's the fundamentals. That's supply and demand. That's our short supply and good demand going on. And let the traders, Frayne mentioned their, traders bailing back into the stock market out of the commodities. So that's what, happened in feeder cattle here as well. And so that's just something that we have to live with day by day. So back to a little bit then on expectation for fall calf prices. Again, we are going to be cyclically higher on prices this year, which is the top chart, because they're already, calf prices are $100 higher right now, and they've been $100 higher all year. So they're going to be cyclical higher, but that doesn't mean that they might go down and fall like they usually do. So we go down to the bottom chart. Then, we left off there at 495 this week. And so this is a scenario that could happen. Again, fed cattle futures prices are the same for fall. Feeder cattle futures are the same as fall. And what happened? I put the line in some of those good things. What happens if, it's getting very, very dry down in the southern plains as Frayne showed you? And so, what if we don't retain as many heifers? Last year, we retained more heifers than we have for a while with the anticipation of rebuilding the herd. Winter wheat conditions were very, very good down there last fall for grazing. What if that doesn't materialize? What if the Corn Belt now is looking very good, but what if, it gets dry there? A lot of things can happen. And usually calf prices do go down seasonally. So if they do follow kind of the fed cattle and so on, and would still be, could be similar. And no, they could be higher than this. Things could be better. And USDA is predicting better fed cattle prices, so they could be higher than last year. But, I'm just saying that there are a lot of things going to affect the market here. And so it's something to watch. And don't be surprised if we go back to a more seasonal pattern of going down into October rather than last year, everything being so good. And actually the high for the year being in October when it's usually low. So I'll keep you updated month by month as we go along here. The other thing is, Frayne showed you the drought monitor map for the entire U.S. So I just pulled North Dakota because it is getting dry out in the western counties. And actually, we have now a change in the livestock forage disaster program with the big, beautiful bill. Used to be, we had to be, and Frayne mentioned D2, that circle that I show you there. There are 2 counties, Golden Valley and McKenzie, now that are in D2. And so counties used to have to be in D2 for 8 consecutive weeks, as shown there in the middle, in order to receive one payment. But the big, beautiful bill changed that to only 4 consecutive weekly payments, or 4 consecutive weeks for one payment. So we've been in those counties now 5 consecutive weeks. So they do qualify for one payment. In the past, as soon as you went into a payment, you could already apply to USDA, but USDA has not updated their software yet. They're waiting for some improvements there and so on. So you can't apply yet. But at some point in time, those 2 counties will be guaranteed one payment. And then now back if we do go to 8 consecutive weeks instead of 1 payment like it was before, they would be eligible for 2 payments. And then if we would go into the D3 extreme drought for 1 week, that would move us up to 3 payments. So we'll have to wait and see if that happens. But no application yet. Ron puts a spreadsheet on our website that you can see what, figure out what your payments would be, but he is not updating that because simply USDA has not made the new 4-week thing functional as of now. So just fed up with more good news for you if you have sheep. Again, lamb prices, and I mentioned the fundamentals here of, again, a short supply and strong demand for lamb, particular export demand. Lamb prices holding in there at record high levels as well, up there $358, $100 higher than they were last year, like calf prices as well. So with that, I'm going to stop sharing and we'll turn it over to Ron.
Ron Haugen, you probably know who I am, farm management specialist. I'm going to talk about the new payment limits. As I was talking to various farm groups this spring, doing presentations, I mentioned these payment limits, but we're going to dive a little bit more into the weeds on them now. So the main things we want to learn here are the bullet points that the payment limits are going to increase from 125,000 to 155,000. It's been 125 for many, many years. I'm not sure how long, but they're raising it up. So it'd actually be 310,000 for married couples. And now this is something they've never had in the payment limits before. They're going to adjust them for inflation every year after this current year. There is going to be an elimination of the income caps for farmers or entities that draw at least 75% of their income from ag or forestry. And this is a new one. They're going to treat all pass-through entities such as S-corps and LLCs the same as joint ventures and partnerships. Now, North Dakota, we don't have corporate farming, so the S-corps wouldn't affect us here, but in most states, they do. So, payment eligibility for the entities then. Previously now, farm operations were structured such that an LLC or an S-corp were limited to a single payment, and it varies by the program. And now S-corps, qualifying LLCs, and joint ventures and partnerships will be treated the same. As we know, you bump up a lot of big, large farmers that farms thousands of acres bump up to those limitations. They have different entities, so they can bump up to that limit on the various entities. Some of these farmers have some lawyers that know all about the FSA rules and have designed some of these things, and they can really max out on their government money if they want to. Now, starting in 2026, for payment eligibility purposes, the FSA will treat LLCs and S-corps like anybody else. Each member then of the qualified pass-through who meets the actively engaged farming criteria will help qualify. So for individuals within these various entities, you must provide contributions. You must be engaged in the farming entity. You must be actively engaged. Also, it also members of all entity types to receive any compensation for labor and management contributes. They use the same qualification as actively engaged in farming. It treats every one of these entities equal. So it kind of simplified things from that regard. Now, retroactively, the 2025 crop year that producers signed up their ARC and PLC over a year ago, the payments will be coming in the fall of 2026. Those payment limits are retroactive for ARC PLC to 155,000. So keep that in mind as well, because those payments are for the 2025 year, but we're getting them in 2026. Also, payment limitations for entities, payment limitations are the maximum amount that a person or an entity can receive for the crop year, directly or indirectly, for USDA programs, Now, the policy change limit calculations takes effect for the 2026 crop year, which we're in right now. So, also, there's still the $900,000 adjusted gross income cap. Okay, but it's relaxed somewhat. If you leave 75% of the average gross income, now this is over 3 years, is from farming, ranching, forestry, and also agritourism, direct consumer sales, and certain equipment sales, which we need some guidance from the IRS on that, exactly what that means, I guess, and from the FSA. Qualified pass-through entities are not required to certify compliance with the AGI, but the members individually must certify this with the FSA office. Now, FSA wants producers that have these various entities and plans to update their farming plan by September 15th this year, and contact your FSA office for more information. So I just thought I would dive into that a little bit and talk to you about the payment limitations. It was quite a monumental change that was passed. So with that, I'll entertain questions at the end, and we'll turn it over to Dave for his presentation.
Great, thanks, Rob. Yep. So a few things going on in bioenergy, and of course we've talked quite a bit or made reference to what's going on in the Middle East and the impacts it has on energy, and then furthermore into agriculture. So to look at some of these really high-level pieces, the challenges in the Middle East are raising energy prices, which in general present some opportunities for those in the energy business domestically, and that of course includes bioenergy and going back up the supply chain back to agriculture itself, especially if you're producing a bioenergy feedstock, corn, vegetable oil, soybeans, canola, and the like are really being supported in part by this. And of course, right now, I think we're still in this period where it's a short-term disruption, although we're starting to see some additional longer-term things play out. And of course, it's kind of a day-by-day, week-by-week issue. We're seeing a lot of movement support coming from EPA's announcement of RVOs for 26 and 27. Those renewable volume obligations, are much higher for biomass-based diesel, and has led to a dramatic increase in RIN prices, which I'll show a chart about in just a second. But very, very supportive of that domestic bioenergy space and pushing back through to veg oil, especially, and back to oil seeds as well. We're seeing discussion about E15 right now. We do have our national waiver for E15 sales, and continued discussion of possibly allowing year-round E15. And finally, ethanol exports remain strong, and in fact, energy exports across the board for the U.S. are quite strong. Not going to present charts today. I might in the future, so that you can see how some of the shifts in trade flows have occurred in the last 2 or 3 months. We're now exporting more crude oil and refined petroleum products, and we're also continuing to have these high levels of ethanol exports. As I mentioned, RIN prices are near record highs. We've almost doubled since the beginning of the year, both for D4 RINs and D6 RINs. D4 RINs are those associated with biomass-based diesel. D6 are conventional RINs, or those associated most often with corn ethanol. And again, that is really indicative of how powerful policy is in moving the market, and really what we've seen, the dramatic increase in those RVOs is that the market needs to adjust, and that there needs to be a pull to do that, and that is indicated in large part by these actual RIN prices. These are the numbers that came out. The EPA set 2 numbers. The set name comes from, this is the second set of RVOs since the numbers in the original bill ended in 2022. So the first batch numbers were set 1. We're now in set 2. In 2028, looking forward, that would be set 3 and so forth. Again, the big change was increasing the numbers for biomass-based diesel, much more in line with where the market is at, both in terms of production and demand, especially that's supported by the state of California. But we're really getting to that point where we're having to catch up fast. and we're actually at a point where we're hitting capacity constraints and feedstock constraints in terms of producing biomass-based diesel, biodiesel, and renewable diesel. E15, we're in an interesting situation. We're continuing on in the summer waiver situation. Just 2 days ago, EPA announced that they were going to extend the emergency waiver by another 20 days. And that's how the law works. So it's a continual, they're 20-day periods and can be renewed. Who knows exactly how long those will continue. We also have this movement on Capitol Hill in terms of having nationwide E15 sales. The House passed it, waiting on the Senate. I don't know what their appetite is. It's important to note, too, that many Midwestern states, not North Dakota, but many Midwestern states do have year-round E15 sales, and they're allowed. And so that is supportive of, having that product available and also available in the markets where it's going to be the lowest cost because you don't have those transportation costs associated with it. At the same time, Midwestern states, with the exception of Illinois, aren't, extremely large motoring states. That the transportation fuel markets are not extremely large. And so it provides, a home for some of the ethanol. But again, it's somewhat limited. Also interesting note that many people haven't caught is in Iowa now, most retail stations have to provide E15. And so if you go to a gas station, in Iowa, you can expect that E15 product will be available. And not only is it possible, which is, what the federal law allows, what, EPA regulations allow, but in this case, Iowa law requires that retail stations actually make that product available. Just a quick chart showing ethanol exports. Continuing this record pace, and this is weekly data, so there's a lot of variation from one week to the next, but clearly continuing on at this record pace. A lot of this is supported by building out, these ethanol markets, and supported by, more recently, to some extent, the disruption caused by the conflict in the Middle East. Exactly where these are going to go, we're going to see. There's also been a lot of news activity in India where they're looking at making E85 available within the market. And again, going from a nation that really had no ethanol fuel use just a few years ago to being a larger market and growing market for ethanol, especially U.S. ethanol. One thing to note, too, and I don't have a slide on it, the United States and Brazil are the largest producers and users of ethanol. Brazil's fleet, their vehicles can run up to 100% ethanol. So they have that fleet capacity as well as the infrastructure to push it out. As they're facing higher energy prices, as the world is, will there be not only will there be increased domestic demand support for higher ethanol use? And right now, I think they're at about E27. And might that increase? And what might that mean also for, exports that they might have and extending back into the sugar complex? So I know, obviously, we have a large sugar industry here in the Red River Valley. And so, we're going to see this interplay if things continue for quite some time to see, continued support for sugar. If Brazil needs to or has this pull to bring things into ethanol, that could use up whatever slack they might have or use up some of that sugar that they would have, that could go into the food market. Again, that's something that's a little bit further off what we're getting there. A bit of news this week about 45Z. Secretary Rollins stated that the USDA tool, the USDA guidelines, will be out this summer. That's really the missing piece. So farmers would be able to calculate, refiners, others to be able to calculate the change in carbon intensity resulting from different production practices. Then, having that information in hand, the refiner could receive a bigger tax credit. And then the following question then is, how much might a farmer get of that? But this is really that missing piece that we're waiting for. And again, right now, it's this summer being the guidance that we've received from the Secretary. Those are the comments that I had. That concludes the presentation portion of the webinar. We'll be back in just over a month on the 16th of July. But with that, we'll go ahead and open it up to questions. I hope there's a few. And I do have one thing. I might send it up to administration as well. Tim, clearly we need to continue to have the webinar to maintain that 368 price. You know, because once or twice it's a coincidence, but there's clearly causality there.
For sure.
Yep. And in fact, maybe we should be looking for sponsors to make sure this thing goes. Another thing I know too, just having Frayne, there's an interesting dimension with 45Z. So 45Z is a production tax credit. So the biofuel has to be produced in the United States. It also requires that the feedstock come from the U.S., Canada, or Mexico. That's an extremely supportive part of the law, which again provides this additional pull, this additional demand for U.S. produced crops, North American crops.
So
okay, here's a question for. Okay, go ahead, Frayne.
Yeah, no, there was a question here. Could you explain how the sugar market affects ethanol markets?
Yeah, so it's a great question. So the tie is actually extremely strong because in Brazil, historically, all of the ethanol was produced with sugar, and in fact, sugar mills in Brazil are two-product plants. They can make sugar, or they can divert some of that sugar into ethanol refining. And so the production of sugar or ethanol is really dependent on those relative prices that exist in the market. And you'll see, year to year, month to month, these shifts in, where mills are focusing their production. And again, it's a market response. And so that tie is extremely strong. The math is generally well known. Those numbers are tracked by a variety of government and industry folks because of the relationship between those markets. And then, of course, because we do have a global sugar market, those changes in ethanol prices as felt by sugar companies in Brazil end up feeding back up into, the global sugar price. And you'll see, and again, from year to year, you have these different dynamics for ethanol and different dynamics for sugar, as well as this interplay. So if we happen to have extremely high sugar prices as we did a few years ago, ethanol production in Brazil declines relatively in response to that. Well, I'm not going to hold anybody long. We'll hold people long in the winter, but since it's summertime, we'll let everybody go. I want to thank all the presenters for speaking today. And again, if you have questions after this, feel free to reach out. If not, we will see you back on Thursday, July 16th. Thanks.